you see the headlines everywhere, right? And that word, foreclosure, it can definitely sound a little scary. But what's the real story behind all the numbers in 2025? Let's dig in, unpack the data, and really try to solve this puzzle together.
With foreclosure filings ticking up, it's super easy to think, uh-oh, here we go again. I mean, the headlines practically scream it. But the real question we need to ask is, does the data actually back up that fear? Is it time to panic?
Okay, so to really get a grip on where we are now, we absolutely have to look at where we've been. Think back to 2010, the peak of the Great Recession. We saw almost 2.9 million foreclosure filings. Now, compare that to right before the pandemic in 2019, when it was under 500,000. And today, we're on pace for about 406,000. So the main takeaway is pretty clear. Yeah, activity is up from those historic lows, but we are nowhere near the crisis levels we saw in the past, not even close.
All right, with that history lesson in mind, let's zoom in and focus on what's happening right now, across the whole country. So what's the big national number? In the third quarter of 2025, 1 out of every 1,402 homes had a foreclosure filing. This one number kind of gives us a baseline, a starting point for the scale of what we're looking at nationwide.
Now, you hear a number like a 17% year-over-year increase, and that sounds alarming, right? But here's the crucial piece of context everyone misses. That increase is coming up from the rock-bottom, historically low numbers we had during all the pandemic moratoriums. In fact, if you compare today's numbers to where we were before all that, back in 2019, we're actually still seeing fewer foreclosures.
But here's where it gets really interesting. A single national number doesn't even begin to tell the whole story. Because foreclosure risk isn't spread out like peanut butter across the country. It's really a tale of two very, very different markets. And you can see it immediately on this map. There is a crystal clear concentration of foreclosure activity. States like Florida, Nevada, and South Carolina, they're leading the pack with rates that are way higher than that national average we just talked about.
Let's just zoom in on the top state for a second, Florida. Here, the rate is 1 in every 814 homes. That is nearly twice the national average. So what might feel like a total non-issue in one part of the country is a very real and very stressful situation down there.
Now, for the dramatic part, let's contrast Florida with a state like Vermont. Look at that number. Only 1 in over 30,000 homes is facing foreclosure. I mean, that gap is just massive. And it's the clearest proof you'll find that we're dealing with regional hotspots, not some kind of uniform national wave.
So the big question is why? Why are some homeowners struggling so much while the overall market seems pretty stable? Well, this section dives into the economic tug-of-war that's really defining everything right now.
To understand why the market is so resilient, we have to talk about one of the most important words in real estate, equity. The easiest way to think about it is as your home's financial safety net. It's the difference between what your house is worth and what you still owe, and let me tell you, it is a powerful, powerful tool for getting through tough times. And the scale of that safety net, it's just staggering. American homeowners altogether are sitting on over $35 trillion in home equity. Trillion with a T. This right here is the single biggest reason why we are not seeing a repeat of the 2008 crisis. This massive buffer is what allows most homeowners who get into trouble to sell their home or refinance it, avoiding foreclosure altogether. However, and this is a big however, that equity buffer is being tested. Homeowners are getting squeezed, especially in those hotspot states, by things like rapidly rising insurance premiums, higher property taxes, and just the general increase in the cost of everything. These pressures are really starting to chip away at people's budgets. So where exactly is this financial pressure showing up the most? Well, the data is crystal clear. It's in government-backed loans, particularly FHA loans, which are so important for helping first-time buyers. They make up a huge share of the loans that are currently in distress. This isn't a broad problem across all mortgages. It's highly, highly concentrated in these specific segments. And you don't just have to take my word for it. This quote from Marina Walsh at the Mortgage Bankers Association just nails it. She points out that FHA borrowers often have tighter budgets to start with, so when costs for things like insurance and taxes shoot up, it just hits them that much harder. You know, anytime you talk about foreclosures, it's impossible not to think about the 2008 subprime crisis. But to really understand today, we have to get the past right. So let's clear up some really common myths. The story of 2008 gets oversimplified all the time. And understanding what really happened back then is the key to seeing why today is just a completely different animal.
Okay, let's start with a big one. Myth number one. The 2008 crisis was all about adjustable rate mortgages resetting to way higher payments. Now that was definitely a factor, but the data shows that fixed-rate subprime loans were defaulting at similarly crazy rates. The real culprit wasn't just the loan type, it was the terrible quality and super risky underwriting of the loans themselves.
And how about the idea of these low teaser rates luring in subprime borrowers? Another myth. See, prime borrowers with good credit could get those low initial rates, but subprime loans, they started high, like 7 to 9%. They were expensive right from day one. The risk was baked in from the very beginning, which is nothing like the much tougher lending standards we have today. So, let's pull all of this together. What does the future hold? The market is really defined by this tension, this battle between incredible resilience on one side and very targeted risk on the other.
It's also super important to remember that foreclosure is a long, drawn-out process. From that first missed payment all the way to a bank repossession, the average journey right now takes about 608 days. That's well over a year and a half. This long runway gives homeowners time and, crucially, options to avoid that worst-case scenario.
So, what are the big takeaways here? If you're going to remember anything, remember this. First, foreclosures are up, but they are not at crisis levels. Second, this whole thing is a story of regional hotspots, not a national wave. Third, that record-high homeowner equity is acting as a massive financial buffer for the market. And finally, the financial stress we are seeing is highly concentrated in a specific corner of the market, FHA loans.
And so we're left with this central tension, this big question. On one side, you have this incredibly strong defense in the form of homeowner equity. But on the other, you have real financial pressure building for a very specific group of homeowners. So the question for the future is, which force is ultimately going to win out? The market's overall resilience or its growing pockets of risk?